So now let's first look at debt investment. As I just mentioned, debt investment is basically, so if I'm a firm, I invest in debt security of other firms. And then that investment, that is recorded as an investment for me, for the party who purchased those debt securities. So regarding debt security, there can be three different categories of debt security, accounting-wise. How we account for it, we have three ways to account for debt securities. The first one is called held to maturity securities. The second is called trading security, and the third is called available for sale securities. And you may ask that, then how do we decide whether to classify a debt investment as held to maturity, trading security, or available for sale security? And the answer here is how to classify it entirely depends on the investor's intention. So what the investor intends to do with the investment. And specifically, if the investor, so if the party who purchased those debt security, they have the positive intent and ability to hold the investment to maturity, then it is classified as held to maturity. And then whereas if the investment is actively managed in a trading account for the purpose of profiting from the short-term price change, that is classified as trading security. And if the investor does not plan to trade them actively, but the investment is available for to be sold, given the right combination of market factor and the investment and the investor's cash situation, that is classified as available for sale. So that is how we classify a debt security into either held to maturity, available for sale, or trading security. And so how we classify debt investment, it will affect the accounting treatment for that debt security. And the major differences in accounting treatment, that is how we treat the unrealized holding gain or loss. Or in other words, that is the gain or loss that hasn't been realized yet. The unrealized gain or loss is basically the gain or loss resulting from the change in the fair value of the asset. But because we haven't sold the asset yet, so they haven't been realized yet, that is called unrealized gain or loss. So the major difference in the three different categories, that is, as for accounting, that is how we account for unrealized gain or loss. And we're going to talk about it in detail in a minute. But in summary, the difference is if it is held to maturity, then unrealized gain or loss, it doesn't matter. It's irrelevant for us because we do, even though, so those unrealized gain or loss, so even though it is unrealized, but we actually, because we plan to hold it until maturity, so they're irrelevant for us because we don't plan to sell it anyway. So that's why we don't recognize it under this situation. However, if it is a trading security, which is managed in a trading account, we're trying to profit from the short-term change in the market price of that security, then that is relevant for us. So they need those unrealized holding gain or loss, they need to be recognized in net income. So they affect our net income. They are going into our income statement directly. And then through the impact in net income, they will be recognized eventually into our retained earning account. And then if it is classified as available for sale security, which means that we don't plan to trade it actively, but we may sell it given the right market condition. So under this situation, there are also the unrealized holding gain or loss is also relevant for us. But because we don't plan to trade it actively, so they are not going to go directly into our net income. Instead, we're putting them into other comprehensive income. And then through the other comprehensive income, they are going to be eventually be recognized into accumulated other comprehensive income. So those are the major differences among the three different categories. And then as for the balance sheet impact, so on the balance sheet, if a debt investment is classified as held to maturity, then the unrealized holding gain loss, it doesn't impact the value of the asset on the balance sheet. They are carried on the balance sheet at amortized cost, versus the other two, they are carried on the balance sheet at fair value. So we're going to talk more about this in a minute. And this is just a brief summary of the three categories.